The physical market just officially broke the matrix. The Shanghai Gold Exchange just closed their trading session, and the numbers coming out of the East are absolutely staggering. They just closed physical silver at $104 an ounce. Let me repeat that, so the magnitude of this event sinks in. $104 for a single ounce of physical silver. Meanwhile, the Western paper market on the COMEX is desperately trying to hold the illusion together at $90. That is a massive, undeniable double-digit premium. We are looking at well over a $10 premium for physical metal over the digital Western spot price. This is not a temporary supply chain glitch. This is not a local tax anomaly. This is a violently broken global market. When you have a $10 arbitrage gap between New York and Shanghai, you trigger a financial black hole. Institutional traders and sovereign wealth funds are looking at the $10 spread, and they are aggressively going to work. They are buying the cheap, artificially suppressed paper contracts in the West, standing for immediate physical delivery, and loading those bars onto cargo ships. They are shipping them directly to China and dumping them into that $104 bid. They are draining the COMEX and the LBMA dry, and they are locking in a massive risk-free profit on every single ounce they move. The Western bullion banks are completely trapped in a mathematical nightmare. If they let the paper price rise to $95 or $100 to close the gap, they instantly blow up their massive naked short positions. They will trigger catastrophic margin calls that will wipe out entire trading desks. But if they forcefully keep the paper price suppressed at $90, they guarantee that every last physical ounce will be bought, boarded onto a ship, and sent to the East. They are being forced to choose between a digital derivative collapse today or an empty vault default tomorrow. And while Wall Street is paralyzed by this arbitrage trap, the Chinese industrial machine is aggressively securing its future. They do not care about the premium. They care about survival. Let's talk about exactly why the Chinese industrialists are willingly paying $104, while the West is staring at a $90 screen. They are not doing this for fun. They are not speculating on a chart. They are doing this because their entire manufacturing supply chain is starving for raw physical metal. China completely dominates the global production of solar panels, electric vehicles, and advanced electronics. You cannot manufacture a single one of those technologies with a COMEX paper contract. You cannot solder a digital derivative onto a high-tech circuit board. If a massive Chinese solar factory runs out of physical silver, their entire assembly line stops dead. An assembly line shutdown costs these mega corporations billions of dollars in lost international contracts and ruined infrastructure. To them, paying a $10 or $15 premium on a single ounce of silver is literally nothing. It is just the necessary cost of doing business to keep the machines running. They are weaponizing their massive industrial demand against the fragile, manipulated Western paper market. They are effectively saying to New York and London, keep playing your digital derivative games. We will take all the actual wealth. And while the mainstream financial media tries to explain this away as a temporary shipping issue or an import tax glitch, the global supply is evaporating. You do not see a sustained $10 arbitrage gap because of a shipping delay. You see a $10 gap because the global physical market is completely out of equilibrium. The West is actively subsidizing the East's technological and industrial dominance by artificially suppressing the price of the most critical metal on Earth. And the East is happily draining our vaults dry, ounce by ounce, ship by ship. But the physical drain is only one half of the equation today, because while the physical market is breaking in Shanghai, the technical charts in the West just flashed one of the most violent warning signals in existence. We need to talk about the gold to silver ratio. Let's talk about the gold to silver ratio, the GSR. Because this is not just another line on a chart, it is the absolute gravitational pull of the entire precious metals market. Today, the GSR just violently crashed right through its 50-day moving average. For the ones who do not read the tape, let me translate exactly what a sub-50 DMA crash actually means for your portfolio. It means silver is officially decoupling. It is moving faster, harder, and more violently than gold. The historical elastic band has been stretched to its absolute breaking point for years, and it is finally snapping back. But here is the structural secret that the mainstream media will never explain to you. The Wall Street trading algorithms do not read the news. They do not care about geopolitical headlines. They read moving averages and momentum indicators. When the GSR breaks below that critical 50-day moving average, every single trend-following algorithm on the planet gets the exact same digital signal. The signal is short the ratio, sell gold, buy silver. It creates a massive mechanical algorithmic bid underneath the silver market that the naked short sellers simply cannot stop. The computers take over and they start buying the momentum relentlessly. This is exactly how you get a short squeeze that goes completely vertical. You have the physical market in Shanghai demanding metal at $104, draining the physical supply. And simultaneously, you have the Western algorithms automatically buying paper silver because the GSR just broke a critical technical floor. It is a perfect, inescapable storm for the bullion banks. They are being attacked by physical reality in the East and by their own digital algorithms in the West. The machines that they built to suppress the price are now turning directly against them. If you are waiting for a pullback to buy the dip, you are completely misreading the structure of this market. When the GSR breaks down like this, the dips become shallow, terrifyingly fast, and immediately bought up by the institutional computers. You are not trading against retail investors anymore. You are trading against high-frequency algorithms and sovereign nations. They are locking in their positions for the greatest wealth transfer in history, and they are doing it right now. So here's the final verdict on the data we are seeing today. We are witnessing the absolute fracturing of the global pricing mechanism for silver. You have a massive double-digit $10 premium sitting in Shanghai at $104. And simultaneously, you have the Western paper algorithms aggressively buying silver because the gold to silver ratio just violently crashed through its 50-day moving average. The East is pulling the physical metal, and the West is automatically bidding up the paper derivatives. The short sellers on Wall Street are caught in the middle of a global vice grip, and the pressure is only going to exponentially increase. When you see an arbitrage gap this massive, it means the fractional reserve system is completely failing to maintain its illusion. The physical reality is violently decoupling from the digital lies on your trading screen. So what is your exact battle plan in this environment? First, you absolutely must not try to day trade this volatility with leveraged paper contracts. The bullion banks are going to fight for their lives. They will create massive, terrifying red candles on the 5-minute charts just to hunt your stop losses and steal your position. They want you to panic sell your digital calls. They want to shake you out before the real structural revaluation happens. The only way to completely neutralize their algorithmic attacks is to step outside of their casino entirely. If you hold the physical metal in your own possession, you do not have counterparty risk. You do not care if the COMEX paper price temporarily drops to $85 because you know the Chinese industrial machine is eagerly paying over $100. You are holding the exact finite physical asset that the entire global green energy transition desperately requires. You are directly front-running the largest sovereign wealth funds on the planet. Let the mainstream media pundits try to explain away the Shanghai premium. Let them tell their viewers that everything is fine while the Western vaults bleed dry. You have the raw data. You know exactly what a $10 arbitrage gap means for the future of the fiat system. I want to know who is tracking this historic divergence with me. I want to know who is ignoring the paper noise and focusing entirely on the physical flow of wealth. Drop a comment below right now with the exact words, "I see the premium." Let the algorithms read that. Let them see that their psychological games are failing. The paper illusion is breaking and the physical reality is here. The weak hands are waiting for permission from the television. The wolves are already positioned. Stay liquid. Stay dangerous.